So I'd like to welcome everyone to our panel on private equity and employee share ownership and profit sharing. Today, we're really pleased to have the top experts in the world in scholarship studying private equity to address the question whether employees could be included in sharing the value of the equity and capital gains in private equity transactions and the profits that are developed by such firms. First, I want to introduce everyone, and I'll ask Oliver Gottschalk first to introduce himself.
Fantastic. Thank you very much, and a great pleasure to be here on this panel on this very important topic. Oliver Gottschalk, I'm professor at HEC, the Paris Business School. I've been studying private equity for about 20 years, looking empirically at a variety of questions related to risk and return, performance drivers of private equity. And one of the deeper dives of my research have been around the impact of stock ownership on private equity deal success, stock ownership not only of top management, but of employees, and the mechanisms, the motivational mechanisms through which this translates into performance.
Wonderful. Thank you for joining us, Oliver. Donald Siegel is another one of our scholar panelists. And Donald, would you please introduce yourself and your background?
Sure. My name is Don Siegel, and I am Foundation Professor of Public Policy and Management and Director of the School of Public Affairs at Arizona State University. And I've been studying private equity now for around 25 years, starting in my dissertation. And my spin on this issue is I am interested in analyzing the real effects of private equity, the effects on productivity, the effects on workers, and the effects on innovation. And that's always been the focus of my interest in this topic. And I'll be reporting on that in a few minutes.
Thank you very much for joining us, Don. Ayako Yasuda, welcome to the panel, and please give a little bit about your background.
Sure. Thank you for having me on the panel. My name is Ayako Yasuda, and I'm the professor of finance at the Graduate School of Management at University of California, Davis. I have been studying private equity and venture capital for a number of years, over a decade. And more recently, I have been studying impact investing, which is a segment of private equity and venture capital that's growing rapidly and is relevant for this topic today. So I would be happy to discuss some of the research that I've been doing in a moment.
Welcome. Thank you so much for joining us. And Douglas Cummings, thank you so much for being part of the panel. And would you give a little bit about your biography, please?
Thanks very much. Douglas Cummings. I'm a professor of finance and entrepreneurship, the DeSantis Distinguished Professor here at Florida Atlantic University. I've been studying private equity and venture capital for about 25 years. I've produced a number of articles on topic, over 100 papers on topic, and edited a few books, including a few Oxford handbooks on private equity, venture capital, and entrepreneurial finance. And I'm very pleased to join the panel and the other great speakers. Thank you.
Wonderful. Thank you so much, Douglas. So my name is Joseph Blasi. I'm the director of the Institute for the Study of Employee Ownership and Profit Sharing here at Rutgers School of Management and Labor Relations. And I also serve as the J. Robert Beister Distinguished Professor of Employee Share Ownership. Just briefly, the Institute involves a competitive fellowship program for scholars. We have over 150 scholars around the country, several academic conferences annually, a empirical research study program, a policy analysis unit, a technical assistance unit for New York and New Jersey for small business owners who are selling their companies, and a curriculum library for professors at business schools, colleges, and community colleges who are interested in these topics. So I just want to give a very, very brief introduction, just sort of laying out some of the general issues that we want to talk about. So what motivated this conference? This is the third annual conference that we've had. is the increasing presence and power and influence of the private equity sector in the country. The fact that private equity has now taken over so many firms with so much employment and wealth that it can be called by labor experts a new employment sector in the United States. That private equity clearly has a very significant role in creating and in concentrating wealth at a time in which wealth inequality has become a central public issue, and whether there are ways to involve, because of all of this, whether there are ways to involve the working middle class, regular workers and managers in sharing the capital gains from equity and the profits from the portfolio firms of private equity firms, and to in any way modulate or decrease some of the more difficult stories of wage benefit cuts and sort of a shrinking of the working person's dream that many critics of private equity have brought up. That's just framing the issue, and I'm just delighted we're going to have each of our panelists talk about their research and their views on these questions, and then we will talk about some of the questions that emerge and have an open discussion. So first we'll go to Oliver, and thank you so much, Oliver, for your presentation.
Fantastic. Thank you very much. I'm very happy to kick off the conversation here. And I'd like to share some observations I've made during my empirical research on private equity and on private equity on businesses. The empirical setting is the European one. And in Europe, obviously, private equity has become of similar scale, magnitude, and appearance of private equity as in North America. Europe, I think, as a continent, has been at least as skeptical towards private equity and its impact on the companies under private equity ownership, on wealth creation and inequality, as the United States have been. And from those perspectives, I've early on in my academic career looked in particular at the implications of private equity on incentives within the acquired businesses, and then also at the motivational drivers of different people to work for a buyout. In a nutshell, I started out with the ambition to understand to what extent it really matters, and matters for performance of the buyout, for the success, for the financial success of the investment from the private equity firm's perspective, to share upside, to incentivize not only the CEO, but also the whole C-suite and increasingly broader levels of the organization. My finding initially during my PhD work was a very interesting non-finding. I gathered confidential information on several hundred European buyouts of the degree of stock ownership at different levels of the organization, the acquired company, and related this to a variety of financial performance indicators of those buyouts and exit. I could not find any meaningful relationship in the sense that more incentives matter for performance, that broader incentives matter for performance, which was at the time a bit of a challenge to the progress of my PhD. But I pivoted, and I find indeed, I think, a very interesting other angle that's very relevant for the conversation today, namely the different motivational mechanisms that are triggered through a buyout. Most fundamentally, we differentiate, of course, between the extrinsic, more financially, externally driven type of motivation and the intrinsic one, the more kind of internal motivation driven by a desire to learn, to grow, to self-actualize, to have fun, to be autonomous. And interestingly, by studying empirically the private equity owned businesses, I found that interestingly, the buyout plays possibly on both buttons and does not only drive the extrinsic part through the stock ownership, but also drives the intrinsic one. Not in a uniform fashion, with a meaningful level of kind of dispersion around what is out there, but indeed the level to which the buyout triggers intrinsic motivation in the workforce and top management team became a variable that explains performance, becomes apparently a driver of returns. And here's the interesting link. I was able to demonstrate that a private equity deal not only triggers financial ownership in the management and the employees, it also triggers emotional co-ownership. People in private equity owned businesses, when the deal is done right and well communicated, actually start to act and think like co-owners, like entrepreneurs in the C-suite and throughout the organization. And I'm not going to bore people with the dissertation work at the time, but there are basically nuances that influence and moderate the impact of financial incentives for the buyout to be understood as a much broader big bang that can reshape the organization and then trigger these other much more powerful drivers of motivation. And I think that's an interesting observation if we think about how broadly to design incentives and how to see how we can leverage private equity as a vehicle to become something that's actually productive and interesting to revitalize businesses and put them on a growth track that benefits ideally both the financial investors and the company and its employees.
Well, thank you very much, Oliver. You've raised a lot of very important issues. We will continue with the presentation from the other scholars, and then we will start to discuss some of these issues. So Donald Siegel will go next, and let's hear your ideas, Donald.
Thank you. My interest in private equity, and I'm so old that I remember when we used to call them leverage buyouts and management buyouts, stems on the effects of these transactions on real economic variables. The three variables I'll talk about are productivity, workers, and innovation. Now, it's important to note that the early work that was done on private equity was based on very aggregate data at the firm level. So the initial studies were done on full firm buyouts. And what we were able to do, this is in my dissertation and subsequent work, is kind of go to the plant level, the establishment level. And those studies, most studies of private equity focus on financial effects, on the effects on stock prices, accounting profitability, and not on productivity or economic efficiency. And the third is that most studies were not looking at how such transactions directly affect workers. So when I was a graduate student, I had access to the Census Bureau data, the plant level census data, and then we were able to get access to those kinds of data in other countries. So what I'm going to report on are the effects of private equity on productivity, on workers, and on innovation. What do these studies show? Well, they show that there are substantial gains in real economic performance and productivity, whether that's labor productivity or what economists consider to be the best metric of economic performance, total factor productivity. So what we observe is kind of like a U shape. Productivity is declining before the transactions and then increasing after the transactions. So very strong evidence that private equity enhances economic efficiency. How does it affect workers? Well, it does lead to declines in employment. But most of the declines in employment occur with non-production workers, not production workers. But at the same time, as it leads to some downsizing of the workforce, it leads to improvements in human resource management practices, what most people who study HRM consider to be high performance workplace practices. It leads to increases in employee empowerment. It leads to training, more employee training, and higher wages. Now, as an economist who also studies innovation, I was also very interested in analyzing the effects of private equity on innovation, because one of the criticisms of private equity deals is that they stifle innovation. Well, that's not what the empirical evidence shows. The empirical evidence shows that there are no reductions in R&D investment in the aftermath of private equity deals, and that private equity transactions increase the quality of patents, which is a good measure of innovation, and also leads to an acceleration of early stage investments, of the commercialization of early stage technologies. And I was able to collect that evidence from a very large public sector venture capital program called the SBIR program. And what we found was that early stage companies in high-tech industries that attracted private equity investment were much more successful than comparable early stage firms that had not attracted private equity investment, and were much more successful in terms of commercializing these very important basic research projects. So the bottom line is that private equity has very positive effects on economic performance, for workers, and for innovation, which are all three critical economic variables, real effects. Private equity deals have very positive real effects.
Okay, well, thank you very much. Those are very interesting findings, and I'm sure they're going to help us raise some important questions for discussion in a bit. Our next scholar will be Ayako Yasuda, who will present about her research and her views. Thank you very much.
Thank you again for having me on the panel. Worker share ownership in private equity is a very intriguing idea and a timely one. I will comment on two trends that I think will increase exploration and implementation of this concept in the PE space in the future, near future. Then I'll raise some practical questions that I think need to be addressed if workers were to receive a significant portion of their compensation in equity. First, as I briefly mentioned before, impact investing is a nascent but growing component of private equity and venture capital that will likely embrace worker share ownership. According to Bain's recent report, AUM of dedicated PE and VC impact funds reached $28 billion in 2019, with large PE firms like TPG, KKR, and Bain themselves raising large dedicated impact PE funds for the first time. This is still less than 10% of all buyout funds raised, but its fast growth parallels a push by large asset owners like pensions and sovereign wealth funds to incorporate ESG principles to all areas of their portfolios, including private assets. As Larry Fink, the CEO of BlackRock, pointed out in his annual letter to CEOs in 2019, what's underlying these parallel trends is, and I quote, the largest transfer of wealth in history, $24 trillion from baby boomers to millennials. As wealth shifts and investing preferences change, environmental, social, and governance issues will be increasingly material to corporate valuations, end quote. So with this impending transfer of wealth to younger generations, more PE and VC firms are quickly implementing ESG into their due diligence and reporting practices. Now, I want to emphasize that ESG is not equal to impact investing. A vast majority of ESG investments is materiality focused. As Larry Fink's letter noted, materiality means ESG factors could impact a company's financial performance and valuation. And when materiality-driven investors incorporate ESG factors, their goal is still the long-term value maximization of the company and not the sustainability of the broader society or the environment. In contrast, impact investing is investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So the focus of impact investing is sustainability of the broader society, which includes the welfare of the company workers. So my initial prediction is that worker share ownership will be embraced and implemented more frequently by impact funds, especially those that focus on poverty, minority and women, and community development, rather than traditional PE firms. For these impact funds, the number of living wage jobs with benefits that their investment in the company generates is often reported as their social impact metric. So with implementation of equity grants, they could report the number of jobs where the workers share and the equity upside. Now, second, another growing segment of private equity that already practices equity-based compensation for their workers is the technology sector. As I discuss in my forthcoming textbook, as the tech sector has grown in the economy, tech as percentage of overall PE deals also increased sharply. Last year, about 20% of PE investments by dollar volume was in tech industry. And many PE firms are raising tech dedicated funds, specialists like Vista, Thoma Bravo, and Silver Lake, and generalists like KKR and Carlyle alike. Enterprise software companies with SaaS-based subscription models are popular tech PE targets, as well as hardware and IT services companies. Since many of these firms are either VC-backed or publicly traded prior to be taken over by PE owners, high-skilled workers at these companies likely already receive and expect to continue to receive equity-based compensation as part of their pay packages. By one study's calculations, equity-based compensation represents almost 45% of total compensation to high-skilled labor. Little is known empirically about how and if the compensation practice of these companies changes under PE ownership, and it will be fascinating to learn more about this. I note that the type of workers that impact fund portfolio companies and tech-focused PE fund portfolio companies employ are starkly different. Owners' incentives for providing equity grants are also quite different. Impact funds are incented to reduce inequality, while tech companies are motivated to hire and retain talent. But there may be cases where, for example, in hardware sector, with high-skilled engineers on the one hand and factory workers on the other hand, both types of workers are employed by the same company. In the recent years, this materiality argument for fighting inequality includes meeting the demands of high-skilled workers who hold their employees to a higher standard and threaten to walk out if they do not change. So I'm curious if this opens a possibility of broader-based equity grants, not just to highly skilled workers, but to all workers at such companies, and if PE owners act more or less friendly to such an idea. In my third comment, is it still okay to go a couple more minutes? So in my third comment, I want to raise a couple of questions regarding implementing worker share ownership under PE ownership. First is the illiquidity of private equity as opposed to liquid stock grants at public companies. For workers and their families who are liquidity constrained, who face unexpected and expected liquidity needs while they work at PE-owned firms, how costly is it that their equity shares cannot be cashed out until presumably the exit by the PE firm? What would happen if workers need to leave the company before the investment exits? Is there an innovative mechanism whereby PE owners of the firm who manages a portfolio of companies they control and therefore have a more diversified cash flow streams in any given year could pool resources across portfolio companies and provide liquidity to workers if and when needed? My second question is the downside risk in event of bankruptcies or failures of companies. Since your wage is already highly correlated with the performance of the company, we as economists do not recommend adding further exposure to the firm by owning company stock as a general rule. Enron provides a cautionary tale whose workers lost everything after investing their retirement in the Enron stock. So will employee stock be treated the same as those of the management and the PE owners in case of bankruptcy? This raises a concern since PE firms are skilled at renegotiating and recovering from financial distress in Chapter 11 bankruptcies, but workers are not expected to be. So I would like to learn what a potential role of impact bankers may be in solving this issue under financial distress. So those are my remarks, and I'm looking forward to learning from everybody else. Thank you.
Well, those are great questions. Thank you very much. Now we're going to hear from our final scholar, Douglas Cumming, who will present his point of view. And Doug has a PowerPoint, which he's now sharing with us. Thank you, Doug.
You do. Thanks very much. I created some slides earlier today just to keep myself on time. And then I thought, just to make sure I narrow the focus. And so with the title of the symposium being employee share ownership, I thought, well, let me cut to the heart of the matter and talk about private equity and ESOPs, the employee share ownership program. And there really isn't much written on this topic. And so when you go to Google Scholar and do a search, for example, one of the top papers that comes up is a book chapter in the National Center for Employee Ownership. And they discuss many interesting features about the benefits of private equity co-investing with ESOPs. So formal programs that enable employee share ownership, and they're, if you will, co-investors. And particularly the benefit that they see, as with many other practitioner papers and the like that you find on the internet, is the following. Firstly, you can defer or eliminate the capital gains tax. And as everybody in the audience, I'm sure knows, that capital gains tax are one of the most important things for spurring on private equity and venture capital investment. It's evidence from the US with the tax cuts in the late 70s, late capital gains tax cuts in the late 70s, for instance. And when you do international comparisons, countries with lower capital gains tax have higher private equity investment levels. So that's something that we definitely like. Secondly, reinvest in the business in an attractive security that includes a current cash return plus equity upside, taken right out of this Rico and Starr book chapter. Thirdly, it's an attractive retirement benefit to reward employees. So just as the others have discussed, motivating employees is normally good for things like encouraging innovation, reducing moral hazard problems, all sorts of reasons why we give stock options and the like to employees. And then lastly, the benefit is that they tout is a legacy for the seller, shareholders, and their employees. So you're really creating something for the employees that gets around these, like this German politician, Franz Munterfing, who said private equity funds are like locusts that feed off employees. This is a way of getting directly at these issues. In this chapter, as well as other places on the internet that you find, is that there's claims, although I haven't seen data on this, that private equity and ESOP programs co-invested generate returns that are comparable to other buyout structures. And so there's no cost to the private equity firm associated with doing this. And again, if you want the source, that's the source. So I thought, let's begin with this conventional wisdom. And then what I'd like to now do is take a step back and look at the evolution of private equity over time and ask the question, well, is this really the way to go? And with private equity, as with venture capital, we're mostly interested in profiting through exit opportunities. We're not really investing for dividends on equity or interest on debt. Really, we want an exit. So private equity investors, normally 3 to 5 years, selling for reasons of a capital gain. That's how these funds are structured as limited partnerships, and there's a limited lifetime. You need those capital gains. That's extremely well accepted. And so many scholars over the years have written about the fact that IPOs have been very thin for a long, long time. And IPOs have traditionally been a main exit outcome for private equity funds and venture capital funds. Of course, acquisitions at times do as well as IPOs, but IPOs have been traditionally the area in which much of the returns have been generated. And so then the bigger question is, within IPO markets, we have to wonder, how has deal quality evolved? And Don Siegel and others have documented this traditional work. I think, in fact, Don was one of the first guys that worked on these topics, showing how there are productivity improvements following buyouts, for example. But then if you look at recent studies over the recent years, a lot of people are questioning these the evidence there with more recent data. And in fact, many people showing negative productivity effects, negative employment effects associated with buyouts, and particularly after the global financial crisis that began August 2007, at least many people claim it began August 2007 and it carried through to 2009. So just a bit more about the data. So the data show indeed, so PitchBook, this is one of the more popular companies to get private equity data from these days. If you look at a typical PitchBook picture, you see that, for example, on this one, buyout exits by value, IPOs are becoming small to trivial, very trivial, which is not the traditional picture, say in the pre-2006 period. More generally, if you look at IPOs over time, IPOs were huge up into the 1990s. And then with the dot-com burst, alongside regulatory changes, 2004, Sarbanes-Oxley, more recently in the late 2000s, early 2010s, Dodd-Frank, the regulatory costs of being a publicly traded company are now much higher. And so there are way fewer publicly traded companies. In fact, relative to about the peak, I think, which was like 1996, in the United States, there's about half the number of publicly traded companies that there were previously. So IPOs are much, much more thin, and that's increasingly not very viable exit outcome for private equity investors. And more generally, you could add venture capital to this as well. Here's data as well from the #1 IPO guy, Jay Ritter, showing how venture capital has likewise dried up in terms of exits. So it's not just private equity, venture capital, a subset of that specifically hurt as well. And so what about this evidence of deal quality going down after the crisis? So I talked about some earlier papers before, and again, these evidence that buyouts enhance innovation. And this second paper, by the way, is, I should have had all the co-authors on there. Mike Wright was probably one of the leading scholars on this topic alongside Don Siegel. They produced many great papers on this. And certainly if you take pre-financial crisis data, then certainly we see this evidence that buyouts enhance innovation. But then, I've done a little bit of work on this, but I'm not the only person. I cited a bunch of papers earlier. There's another paper, Yash and Egan. When you look at data post-crisis, that you see a rather different picture. So for instance, just some stats in our recent paper, 17 to 22% decline in the number of patents, a 45% drop in the citations. And then even if you look at the different types of innovations that we might care more about, like radical innovations, then that too drops off significantly in numbers and quality. And very consistent evidence found elsewhere, so we're not just the only ones reporting on this. Also, this has been picked up by, for example, the Institutional Investor publication. So So while we see, perhaps many great gains to private equity funds mixing with ESOPs, and ESOPs facilitating an exit, almost akin to like a buyback exit or a repurchase. I'm not necessarily convinced that that's going to solve the problem. So we have this, worse exit market. Here's a solution to invest alongside ESOPs. With this other evidence of private equity deal quality evolving in recent years, whether or not ESOPs are the golden ticket to help solve these issues, I think it's a matter for open discussion. I certainly see many benefits with employee share ownership and the like, but particularly focused on these ESOP programs. I'm not sure that that's going to get us to this great private equity market that we had previously seen in the glory days. So thank you again, and I look forward to our discussion.
Thank you very much, Doug. So I thought that what we do right now is each of us would take an opportunity for a minute or two to comment on some of the other questions that have been raised and to raise some other issues. I have a number of broader questions to tee up, but why don't we go in the order that we went in for comments and raising questions and responses. So Oliver, we'll start with you.
Certainly. Thank you very much. I'd like to particularly drill deeper into the finding about, the private equity impact on employment. And, I've seen the different studies related to Don's good work in this area for quite some time. And they're one of the things that I like to use both in academic conversations and in teaching with practitioners, because I think they very nicely illustrate what private equity can do if it's correctly applied. It can work for companies in the positive sense of the fitness camp and then get them more rapidly through these transition periods. There's often a misconception with respect to what people can expect from private equity, also with respect to the employees of these acquired businesses. Sometimes the lobbying bodies for private equity present work that'll try to suggest that private equity is a growth machine, which is not. It's a machine and vehicle for corporate transformation and sometimes for rejuvenation. And that's exactly what we see in the data. And I think that's very important to keep in mind from policymakers. You don't necessarily can expect an absolute positive impact of private equity per se. But if you compare it in a nice kind of matched sample type of fashion with what would otherwise have happened to like businesses, you can see that private equity, again, with the right dosage and the right application, can have a very important positive impact, getting companies through these difficult transition processes with ultimately positive consequences for the businesses under private equity ownership and, importantly, their employees. And I think that's something often overlooked in the academic debate of the industry, because it's very, very tough to do this in the right empirical fashion, as Don has done. And I'm very much waiting for similar studies to take place in other parts of the world where private equity is prominent and is sometimes criticized for a similar reason. To the best of my knowledge, nobody in Europe has been able to gather similar data and conduct a similar analysis. But the overall finding is most compelling and as relevant today as when the initial work was done.
Okay, Don, let's hear your reviews.
Well, I think it's very important in analyzing this issue to analyze the most micro data that you have, number one, which means analyzing these relationships at the establishment level, not at the firm level, because a lot of the transactions occur below the firm level. And when you're analyzing such variables as productivity and innovation, you really have to do it below the firm level. And the other thing that has to be done, which Mike did very effectively, was linking data on performance to data sets like the WERS. Joe, you know this data set that has a lot of interesting information on workplace industrial relations, on human resource management practices. If you really want to get a true sense of what's happening to performance and to workers and to innovation, You have to have the right samples. You have to link those data so that you get complete information on the full dimensions of what's happening to workers and to innovation. And the study that we did of the SBIR program was very important, because another problem with existing data that's used to analyze these kinds of transactions is that they tend to focus on more mature industries and not the embryonic high-tech firms. And so that's another kind of dimension to this. So I'm a little skeptical. I'd like to see how those studies were done, the ones that show that productivity is declining and that innovation is declining in the aftermath of these transactions. Because I've been looking at the market for corporate control more generally for many, many years in different countries, and using these plant level data, and you find the same kind of patterns, this U-shaped kind of decline in performance before and improvement. Now, what the economists argue is, well, you don't have good controls for endogeneity when you do those kinds of, you're attributing everything to the event when it may be due to other factors. But yeah, I'm sorry to go on, but
that's very, very helpful. Now we want everybody to go on because we want to develop these things, and I'll give a minute or two of comments. But Ayako, let's hear your reactions to the first part of our discussion.
Sure. Let me just, I have two comments. Let me just first chime in about what PE does. I think we cannot generalize without regard to what industry and what kind of competitive environment that the companies operate in. My understanding is that where the companies they take over are in competitive product markets, for example, in the manufacturing industry, I think there is more evidence that the productivity grows after PE take over. And I think I think of PE as just a mechanism where the incentives are in higher gear. So they would do whatever it takes to achieve their goal, which is generally financial performance. So if they operate in a competitive industry, they do that through productivity gains. But I think there is recent evidence where in different sectors away from manufacturing, the outcome could be quite different and could be adverse. So for example, in an industry where government subsidies are very, very dominant and the product quality is not really tied to the per unit revenue they earn. So think of places like nursing homes, where governments are paying most of the revenue, and it's a fixed revenue, not tied to product quality, or for-profit education, for-profit colleges. Those are areas where they're doing the same thing. They have incentives in high gear. They're trying to either maximize the top line growth and thereby increasing valuations, but also cutting costs, like, not hiring as many nurses. And so the quality outcome for patients could go down while the financial performance could improve. And I don't think those two are inconsistent. I think it's just that we can't talk in general terms without thinking about what is the competitive environment that the companies are operating in. And I would just add another example of a software. Software is now the darling of tech PE. And this, again, the business model is different. Vista private equity, Vista is famous for implementing this model where they take software companies, maybe in Silicon Valley, but then they move it to somewhere where it's lower cost to hire programmers. So they might hire engineers in Dallas, Texas. That's a lot cheaper than to hire the same quality programmer in Silicon Valley. Again, doing the same thing, but implementing it through different operating models. So I think that's my first comment and response. And the second comment is actually, Doug, I had a similar sort of question about whether the ESOP would constrain the exit options for PE, and whether that could be a sticky point, in implementing this. And when I think about tech PE, they already are doing equity-based compensation for high-skilled labor, but not through ESOP, but through employee stock and option grants that are very, very standard at tech companies. So I guess my question is, does it have to be an ESOP? Setting aside the tax benefits and all that aside, does it have to be ESOP, or can some other innovative contractual arrangements emerge that fits the PE model, that solves the problem from the perspective of PE owners who need to negotiate an exit value? That's like their fundamental goal, much more so than dividends and cash flows in the interim period. And at the same time, can workers participate still? So what is the room for innovative contractual innovation? And I'm not a legal expert on this, but I think that would be very, very important for practitioners to work out.
Great points. Should I chime in? Is that okay?
Absolutely, Doug.
Yeah. So no, definitely great points. So my comments were really narrowly focused on the ESOP, so the formal program, the legal structure of an ESOP, and certainly, even just before lunch, before coming to this, I was telling my lunch partner, "Hey, this is what I'm chatting about. That's why I have to run." And so we were talking about it, and that exact same issue came up. Well, why do it through an ESOP? It's just creating an unnecessary legal hurdle. And so no, you definitely don't need to do it through an ESOP. Although since I thought this was the ESOP seminar, I thought, let me talk about ESOPs in my limited 5 minutes. But certainly more clever contractual arrangements can be put forth, and many employees are rewarded through option grants that do not involve ESOPs. So that's been done very often over the years. Although this increasingly common discussion about ESOPs, how great they would be and are invested as sort of co-investment with private equity, I think is an interesting thing that bears worth discussing. And then the only other couple of things that I'd say, just a little more generally about private equity and jobs, private equity and innovation, is if you take similar methods and run it over a long time series, going from the 90s up until today, is that certainly there seems to have been this shift in outcomes pre-global financial crisis and post-global financial crisis. So you see very positive effects pre-crisis, and then differential effects post-crisis. And then just as another example, so I thought, I did the shameful thing of talking about a paper that I worked on, but let me talk about a different one. There's a European Economic Review paper. I remember Jeff Wood is one of the authors. I'd have to look up the other authors. Recently published about private equity and jobs, and they find indeed quite the opposite of what we typically see. Private equity facilitates employment, and they come to the opposite conclusion with a little more recent data, post-crisis data, that is. So and then a little more broadly is cutting the data and what are the causes of some of these things. At least in our particular cut of the data, we do the usual things, cutting the data millions of ways. One of the things that we saw is that for highly leveraged deals, during times when there's unexpected increases in the cost of debt after the deal and as the deal goes forward, those are the ones that seem to have the most negative productivity effects. So those highly leveraged deals, and then subsequent to the deal, large unexpected increases in the cost of debt financing, those are the ones that had the most dramatic reductions in productivity as measured by patents and patent citations, at least in our project. Those are the ones that seem to be the hardest hit. But again, certainly there does seem to be big differences pre-crisis and post-crisis. So let me Pat talk too long. Let me pass it over to the next person.
Okay, so thank you very much. I'm going to step out of the role of chair and make a few comments, and then I'm going to tee up an issue for us all to discuss, and then suggest that I will tee up issues and we can all tee up issues and then have brief discussions about some of the questions that have come up. So stepping out of my role as chair, obviously I've been involved in the area of legal development of not only of ESOPs, but of broad-based stock options and profit sharing. I'm sorry to say I just turned 71 for 46 years. But I want to make 3 points. First of all, this is really the first symposium of its kind of scholars on this issue. And to your point, Don, we actually don't have a data set on broad-based profit sharing and employee share ownership and private equity. The sessions that have just preceded this session in the conference today involved Rutgers inviting private equity firms and partners to actually present case studies of firms and deal formats where they've actually included employees in broad-based profit sharing and employee equity shares, whether ESOPs or stock options, which was the approach favored by KKR, as you'll see in the KKR study that leads off the conference. So to one extent, the conference is an attempt to create a data set. This is the third annual conference. Hopefully we will create a data set. But right now I would say we're at the point of providing deal formats, demonstration stories, models of how to have broad-based shares, and case studies. And the only thing more than that we're doing is exploring whether there are some legal constructs and policy changes which would facilitate more of these kinds of inclusive capitalism approaches. So I think that's where we are in terms of data. Secondly, one strong impression that I had in listening to these 4 esteemed private equity scholars. I'm a scholar on shares, but not on private equity. But one impression that I had in listening to you is that private equity itself. Well, let me start in a different way. Some people have looked at the Rutgers conference and said, "Oh, this is the bleeding heart liberals trying to figure out a way to get some of the crumbs for workers out of private equity." And I just want to say, no, that's not why we developed this conference and why we're developing a research stream in this area and some policy issues. The reason is, and this really was punctuated by listening to the 4 private equity experts, is the private equity itself has some internal questions that connect to the issue of broad-based employee shares. And just to mention a few of them, we know it's widely publicized that some of the top private equity firms beat the S&P 500, and many of the others just don't. The wealth from those firms is often coming just from the 2% of a management fee and the 20% at the end of the deal, and not from a lot of the internal capital gains. Another issue is that, just as Don Siegel said, creating a high performance HR work system seems to be an important part of these private equity deals. And one thing that I have studied is high performance work systems in the HR research literature, and profit sharing and equity participation on a broad basis is a central part of high performance work systems. A few years ago, I did a book called In the Company of Owners, which focused on the 100 companies that built, made software for, made hardware for, and sold on the internet, published by Basic Books. And what I found is every single company was doing broad-based employee equity participation. The last point that I wanted to make is that obviously whenever the private equity scholars study these firms, you see a natural distribution of performance metrics. The question is, I think, a really key question, and this is raised by some of the cases that preceded this symposium. I mean, we have some films by KKR and some narrative case studies and PowerPoints. And the question is whether including the employees in broad-based equity or profit participation can increase the number of private equity firms that are on this sort of success part of the distribution of performance. So I'll stop there. Those are just some sort of general overview questions, and I thought maybe now I'll invite some other comments either on issues that I raised, or invite any of my fellow scholars to raise an issue that we can all focus on for a few minutes. And I have 3 or 4 issues ready to go after that.
Joe, I was really excited about your idea about the survey, but I'm wondering whether you're familiar with something called the MOPS.
Yes.
You're familiar with that, and Nick Bloom, and because
Yes.
Nick Bloom has written a lot about management practices, and he's kind of, I'm an economist, so I believe in economic imperialism,
Right.
But I think one of the problems with that survey, and you've seen it, is that he didn't consult enough with not just HRM scholars, but with management scholars in general in designing that survey. Because does that have any information on this?
Well, it's interesting that you brought it up. Our institute now has a grant from the Russell Sage Foundation to match up the Department of Labor, U.S. Department of Labor's database on ESOPs with the MOPS.
Oh,
And
okay.
we have
Right.
several scholars now in the research data centers of the census doing that. We were unfortunately interrupted by the pandemic because the census data centers have closed. But we will have some population data on all of U.S. manufacturing, matching the MOPS to ESOPs,
So
and comparing
then-
ESOP and non-ESOP firms.
Then you can match it to the establishment data, which has data on performance.
Right,
of the
absolutely.
plans. I mean, we're getting to my point, which is, if we really want to understand what's going on in the workplace and how private equity affects workers, we need to get down to that level and do a lot of disaggregation and find out which workers are being affected, how they're being affected, and and we look at performance at different levels. And I think financial performance is very important, believe me. But from a policy perspective, these other variables are very important.
Yeah, so in Nick's defense, I will say that in the most, not the MOPS that's happening now, because there's a MOPS survey going on now, but
Right.
in the second MOPS, he did add a number of high performance workplace HR questions, and he did add questions on broad-based bonuses and profit sharing.
Well, I put him in touch with Herm McGinnis. I don't know if you know Herm McGinnis.
Yes.
And, because he does all this performance measurement stuff.
So we will be looking at that, and it will be very good if we could match private equity portfolio firms to the MOPS. So for our listeners who are watching this panel, the MOPS stands for the Management Operations Practices Survey. It's based on a random sample of manufacturing firms in the United States done by the Enterprise Division of the census. Okay, so let's hear from some of our other panel members, and then if you want to tee up a question to discuss, otherwise I have some to tee up. Okay, so I'm going to I'm going to tee up a question which has to do with risk. and I'm going to comment on Ayako's question. So I did a book called The Citizen Share, published by Yale University Press, in which I looked at 250 years of the history of policy and practice on shares, mostly employee ownership, but also profit sharing, not just ESOPs, in US history. And one of the conclusions that I came to is that equity participation by broad groups of workers tended to lead to disastrous results when the workers had to buy into the shares with their wages or their retirement plans. It only led to pretty good results when it was simply based on grants. And I came to the conclusion that there are good and bad forms of employee share ownership. And that clearly the worst form of employer share ownership is in fact the Enron form, where the workers are asked to buy in at a market price on the shares, and then whatever happens, they could become victimized and lose all their savings. And that worker purchases of shares in 401k plans should be, in my view, illegal, and that the format of equity participation that Enron had should be illegal, and that really what government policy should do is encourage grants of profit sharing, broad-based stock options, restricted stock units, and ESOPs, all of which typically are not based on wage substitution or workers, buying into the plans. That doesn't eliminate the risk to workers, but at least it modulates it in some fashion. But in terms of teeing up this issue, what I would say is I think there are two big metrics, economic metrics in our society, which relate to this. One is the recent studies from Sayez and Zuckman. Top 10% have 74% of all capital ownership, capital assets, and wealth. And the top 10% of families have 97% of all capital income, which is capital gains, dividends, and interests. And in a society where you have that, and you have inflation adjusted, flat or declining for many groups in the working middle class wage incomes, I think that we don't have the luxury of saying, equity participation and profit sharing in the firm is too risky. I think we don't have that luxury because we're headed towards feudalism. What we need to do is figure out how could we do equity and profit sharing and modulate the risks in a very radical fashion. So I'm just going to throw the risk issue out for discussion.
Thanks, Joseph. I want to just jump in, and I fully agree about the format, the grants being better than purchasing, but it doesn't really change. So for high skilled labor who are high wage earners, 45% of their compensation being stock-based compensation does not present the same kind of liquidity constraints that it would on, say, factory workers. And I think that cannot be ignored. Also, those stock-based compensation that companies are giving those workers are considered expenses for companies. So I think if we are giving workers part of their total compensation in stock, from the company's perspective, that means if they have a total compensation that they are willing to give to the workers, that means less cash component. And this is sort of tied to my first question, is the liquidity constraint that this might impose on the workers. So I guess the question is, what's the right percentage then for stock-based versus non-stock-based for the workers? that balances the needs for cash and liquidity in the short run, as well as the equity upside that will benefit them in the long run, this intertemporal substitution that they will have to make. How do we do that in a way that balances the immediate liquidity needs? And that's why I was wondering, I was asking in my first question, can there be any mechanism, again, under PE ownership specifically, the workers are tying up a greater portion of their total compensation in an illiquid equity. That means they can't cash it out when their needs hit, but they can still somehow borrow against that to meet their short-term liquidity needs. Otherwise, they will be more liquidity constrained, right? You agree that that just is a direct outcome of switching from all cash to partially equity. For private equity, where the illiquidity is very, very real for a long time.
So I have some thoughts on this, but I'd rather initially hear from the other panelists, and then I'll give a brief comment on the issue of risk.
Sure. Well, I guess in general, I would just add that such enormous inequality amongst people in a society seems to create problems. And there are many well-known economists that are documenting these things. Perhaps Thomas Piketty is one of the more well-known ones. And that, these are issues that are very apparent, especially, I've lived in many different countries around the world. Sometime in the US, I've spent here, but Canada, various European countries, Australia, and even some places in Asia, I've spent some time. And it's very obvious the differences that are really almost thrown in your face in different countries in terms of inequality across folks. And I think those inequalities create political and other problems that we're just starting to see. More specifically on employee share ownership, I really like Iaco's point about illiquidity. And often in private equity deals, there are transfer restrictions, in other words, vesting rights that can become important, and they're put in place in ways that perhaps are not as attractive as they might initially seem to employees. And so, getting stock ownership isn't necessarily going to be a positive thing, or at least there could be other forms of compensation amongst employees in private firms that would make people better off, particularly if they have liquidity needs, or if it has some other restriction on, or onerous incentives, if you put it differently, on where they might work. So those are hard trade-offs to have to make.
Don, how do you weigh in on this issue of risk?
Well, I like the point that Ayako made. I think it is concerning to have a very significant percentage of your compensation tied up in shares. So that's an issue. But again, I would draw, Joe, this literature, Derek Jones, all that literature. I thought that it had been established that employee ownership was good for employees. I mean, why should it be that much different? I mean, that's what I would want to know is, why is this worse than employee ownership in general, share ownership? Because I thought the jury was out on that one. It.
Yeah. No. Generally speaking, I mean, with the exception of some of the Enron cases where employees have bought the stock, our evidence does suggest that employee ownership has been very good for employees, as has been profit sharing. But I would I want to wait till you finish your point before I
Well, no,
Yeah.
I think that now that you're linking all these data sets, and I hope you are successful in doing so, you can get a really rigorous answer to that question. Does private, ownership, employee ownership in private equity deals, whatever you want to call it, does that make employees better off? Now, I would encourage you in doing that, though, to look at every dimension, look at everything that's happening to the employee, looking at wages, benefits, workplace. I mean, the kind of things that they measure in the WERS survey. I don't know exactly what's going on at the American survey, and whatever's going to be in the next wave of the MOPS, but I would encourage you to try to test that rigorously and really, because that's a central question here. Are employees better off if they're involved in these deals or not, in the ways that you've described?
Um, we did a study of about 400,000 employee surveys and close to 1,000 firms, I think around 800 firms that were competitors for Fortune Magazine's 100 Best Company to Work For in America competition. And in that data set, we had the winners and the losers of the competition. Private equity was not representative there. A lot of privately held firms, a lot of publicly traded firms, we found very strong benefits for workers under employee ownership and profit sharing. But to answer specifically Ayoko's question, like how would you structure this, just based on my knowledge, obviously we haven't done the big MOPS study yet. I would say this, and I hearken back to something that Don said about high performance work systems. I would say, based on the literature that I currently know, the evidence that I currently know, what the science would suggest is that you would want a meaningful amount of cash profit sharing or equity participation during the existence of the portfolio firm to be part of the high performance work system. But the evidence shows that that doesn't have to make people into workers into multimillionaires. A meaningful amount is profit sharing, which is not 2% of pay, not 5%. It's probably around 10% on top of pay. And as we know, that amount is very important in these high performance work systems. It's small compared to the rewards that partners and limited partners get in these private equity deals. And then I would suggest that then you would have another reward, which would be viewed as the reward for the capital gain on the whole transaction. And that could be structured as KKR does using stock options. It could also be structured, and our viewers will see the KKR case studies presented before this session, and it can be structured as ESOPs, where the ESOP and the PE firm are jointly invested in a deal, and at exit, the ESOP is used as an exit, and presumably the firm is more efficient, and there is an equity, a capital gain increase in the value of the equity. But what I've now mentioned is my resolution based on what I currently know of Ayako's very important, dilemma. I should say that we have multiple research projects. We did a research project funded by Russell Sage and Rockefeller Foundation at National Bureau for Economic Research. Shared Capitalism at Work is the book that came out of that. And what we found that all of this stuff about incentive effects from financial participation by employees in equity works as long as they report that it is not wage substitution. When employees report that their wages are below market for their region and job type, you'll see in the statistics virtually all of the motivational and turnover advantages of employee share ownership just kind of vanish in the data set. So that would be one condition. But that's all I have to say. If we have any other comments on this issue, or else I'll tee up another question. Go ahead. Go.
Comment. So first, profit sharing does not have this liquidity issue because this is a cash payment at the end of the year. Whereas the equity ownership, generally in private equity, the most of the gains is from the capital gain, and that is only at the end of the PE ownership, at the time of exit. The exceptions to that are special dividends that PE owners sometimes pay themselves before the exit. And so use of dividends is another way to relax that illiquidity if the workers were to receive dividends before the exit of the investments. Again, that's another, would PE owners be willing to pay those dividends to the workers as part of their incentive package or not? That's something that should be on the table to, so profit sharing, bonus at the end of the year, dividends and capital gains at the end of the PE ownership. All of those should be on the table and should be creative in making a incentive aligned contract between the owners and the workers. So that's my additional comment. Thanks. I think you're muted.
Joe, you're on mute.
Thank you very much. Let me tee up another question. So this question has to do with sort of policy implications. What if we were to find from the cases presented just preceding this session and from the cases presented in our last two private equity and financial participation workshops that there were some deal formats where the investors in private equity firms feel that they can make money and they can also involve the employees. What are the policy issues here? And I'm going to be very edgy and say, and put myself out on a limb and say that I don't think these kinds of transactions, even if we figure through some of the risk issues and all the stuff we've talked about, can spread voluntarily. If you look at my book, The Citizen Share, in 1885, as capitalism was expanding it with big industrial complexes like Procter and Gamble and all of these companies in the United States, a bunch of CEOs came together, led by William Cooper Proctor and George Sturgis Pillsbury from Pillsbury, and tried to interest their fellows in doing equity participation and profit sharing in their firms. And basically, this never took off until you got the amendment to the Constitution for corporate individual income taxes, and corporations could say, well, if you'll give me a tax incentive, then I'll do it. So I'm going to go out on a limb and say that I think that we don't know what's going to happen in the coming few years in terms of the carried interest tax incentive, whether it's going to go away or be kept. But I would like to go out on a limb and say that if, as a condition of having the carried interest treatment, a firm had to have a broad-based cash profit sharing or equity participation plan for all of its employees, I think you would get pretty rapid spread of this HR innovation. So love to hear your comments on that.
Well, that's why it's extremely important to be able to show, if in fact this is true, that such transactions enhance economic performance. Because policymakers don't care about, whether investors gain or workers gain in general so much as whether economic performance improves. In fact, I think that's why the plant level work was so important, because the people like Jensen and others were saying, well, stock prices go up, so that's good for the economy. Well, that's not very convincing I mean, unless you're a Chicago economist, you don't get that connection, right? So what you need to be able to show in order to build support for that kind of legislation maybe is that these transactions are enhancing economic efficiency. I also think that it's also important to look at effects on prices. I think the study by Judith Chevalier, a very creative study a long time ago on how private equity and LBOs were affecting prices, consumer prices, because there's always that concern as well. I mean, the more that you can document that these things are good, not for workers, not for investors, but for society, the stronger the support will be. And again, that's not easy to do because Ayako made a very good point before, and maybe this is what's going on. The early LBOs and MBOs and private equity deals were focused a lot on manufacturing where performance and productivity are very easy to measure. We don't even know how to measure productivity in some of these service industries that are undergoing these private equity deals. So it's a mess.
Doug, these policy issues go very much to the many points that you made about private equity's role in society. And I'm curious what you think about them.
No, it's certainly a lot of unanswered questions that deserve more data and analysis. So I'm strictly a data guy that like to speak from what the data have to say. Raises some new questions and digging into the data. The changes in the economy certainly, the new gig economy and deals that people are investing in do indeed give rise to new tools and methods that we need to come up with. Sorting these things out by industry, very critical as well. One earlier point that you made, Joseph, was the heterogeneity across private equity funds. So we too often talk about private equity as a homogeneous asset class, and if anything, it's one of the most heterogeneous. Top private equity funds, top quartile funds are so different than bottom quartile ones, and the mix of the top and bottom that you have in the data set can drastically influence outcomes and inferences. And a lot of our studies talk about the average effect without considering the fact that these deals are really, many of them, putting them in the same data set is combining apples and oranges. So that's another thing that we have to be careful about. And, as we go forward, better data sets and more information, we'll be able to say more things and do more things. But we're certainly, learning a lot from how things have evolved with these big experiments. One thing I think we'll see coming over the years is there's been this influx of COVID papers and as a natural experiment, and it's too early to do a COVID private equity study because you have to, need a little more runway of time to do that kind of thing. But I bet in a year or two's time, the private equity folks will get all excited and see if they can learn a few new things from the COVID days, but to catch up with the other types of studies that can use data on a much more real-time basis. But yeah, lots to do in future periods, and certainly this discussion's been helpful in guiding our thinking, I think.
Ayako, do you have any remarks on these policy questions?
So you're asking how about tying capital gain tax treatment of carried interest to adoption of widespread profit sharing or share ownership. I'm not sure if that's sort of a pretty brute force way of implementing the mechanism. What I see as a perhaps So what I first talked in my comment is impacting funds are the easiest ones to adopt because they already dual bottom line. So it is very much aligned with their objective. And in fact, it's an impact metric to show how widely adopted these practices. That's my prediction. Now, for the more traditional PE firms that are not dedicated impact funds, ESG does affect their incentives now because investment community is rapidly incorporating ESG to their portfolio. So what I see is key to widespread adoption of something like this is, can you show that this is material to the performance and valuation of PE-owned companies? The materiality is real and it's very mainstream now. Everybody wants to see materiality-based ESG incorporated into their investment decisions. So I think the key is to show that this does provide the right incentives for the workers, and PE is incentives in high gear, in my opinion. So if they see that indeed this does improve incentives and therefore the performance, that's where the materiality argument could support this policy. And so I guess in terms of tying it back to the policy, what I see as a big problem in the US in particular, it is the concept of fiduciary duty of investors backing PE funds. A lot of them, particularly the ones that are governing pensions, are very, very stringent and basically does not allow fiduciary to consider anything other than financial factors. Whereas I think in Europe, the fiduciary duty is much less strict. And so pensions have no issues provide a backing PE funds that then want to incorporate the broader benefit to the community or the environment. So any policy reform with respect to the fiduciary duty restriction, ERISA restriction, for example, pensions are 40% of all capital coming to PE. That will have an enormous impact on the investors. And since it will have an impact on investors, it will have an impact on the PE attitude towards worker rights and worker welfare. And I would advocate for that. I would advocate for fiduciary duty for US investors to be more inclusive.
Ayako, is CalPERS allowed to invest in private equity funds?
Yes, and they do. They do
Yeah,
invest.
because I know in New York, my former boss was the head of New York State Teachers Retirement System.
Public and private pensions are the largest contributors to private equity, and it's close to 50% of all contribution. But they are in the U.S. quite strictly bound by the ERISA restriction of fiduciary duty, and that pretty much prohibits them from admitting that there is financial return sacrifice for considering any other non-financial factors. And that I find in my research on impact investing, that fiduciary duty in restrictions makes investors averse to impact investing.
That makes sense. Yeah.
So I'll comment on that, and we'll make this available as part of the symposium. But a group of experts interested in impact investing have created a white paper on norms for private equity firms and capital providers that are interested in impact investing, norms for responsible uses of employee ownership in private equity transactions. And I'll send this report to each of you. There are some family offices involved in the writing of this report. And their view is very different than the policy topic I presented. Their view is exactly yours, that if equity and profit participation by broad-based groups of workers makes sense, then it could simply be driven by the capital providers and doesn't require any tax incentive policy.
Joe, you're familiar with this KLD data set,
Yes, yes, yes.
right? And this is one of the dimensions of social performance, is how you treat your workers.
Right.
Is employee ownership one of the variables that they look at?
I have to go back and check. I think it's something that they were interested in. I mean, I know Amy Domini. She's a friend of mine. She was the developer of obviously of the KLD and this whole area. I have to go back and check how good they
That
are.
might be a way to influence. I wouldn't really call it, when I think policy, I think public policy. But
Right.
If you get that included in that measure, because that's used to screen portfolios, right?
Right.
That's all the social investing, all that market. That would make a lot of sense. And I think they would go for it.
Yeah. So we have two publications on this, one by Marianne Beister, who has a family office, and the Beister Foundation created our institute at Rutgers, and another one by a group of including some family office and impact investor experts. And I'll make both of those available to you. I simply want to mention one other thing, that in the sessions and case studies presented by private equity partners just before our panel, some of them are making the case that they have seen in their case studies of transactions such positive effects from both the high performance work system part of this and other aspects of employees' motivation, that they think that private equity firms that have a lot of dry powder might look at the employee as partners as a way to improve the quality of transactions. And that's a very, very different kind of driver than policy and impact investing. It goes to your materialist observation. But clearly there's sort of a lot of possible drivers of this, on the table.
It's also consistent with this whole stakeholder movement,
Right.
stakeholder involvement kind of movement. I see that's so prevalent in management.
Right. So we're coming up on an hour. I think brevity is always the wise way to go. So I thought maybe I would invite each of us to give sort of a concluding set of comments, questions, alerts, claims, complaints, and then we'll conclude our session. So what if this time we go, would you mind going in reverse order? Doug, would you mind leading off?
Sure. Thanks very much again for the opportunity to join such a great group. I think one of the bigger issues that is facing the private equity industry these days, and has for many years now, is exits. So exits have been tough. Certainly, I think as you have pointed out, Joseph, that employee share ownership is important. There are many social benefits to it. I have yet to see what is going to be the most efficient way in which that's going to facilitate exit outcomes, or if it needs to come alongside other sort of institutional changes that's going to help the development of the market in coming years, or how ownership in other ways can improve things that we've seen over the last decade that are perhaps at a bit of a lower level than what we've traditionally had them at. And so those are tough questions to grapple around. And I hope people look into these things further and broaden the discussion. So thank you.
Thank you very much, Doug. Ayako, let's hear your concluding remarks, please.
Well, this has been a very invigorating discussion. This type of topic is on my mind these days. I'm delivering a lecture on the impact of private equity. So, we are always talking about creation or destruction in private equity. And as I already sort of alluded to a little bit, my view is that you can't generalize, but I do think a lot about these issues. What is the impact of private equity, not just on shareholders, but on the wider society? So this has been a very productive discussion for me. And if anybody is interested in my lecture, it will be held virtually like everything else. So please feel free to reach out to me, and I'm happy to provide the link of the workshop. They've been doing a very interesting lecture series on, this is more broadly on entrepreneurship and innovation, but private equity is a prominent part of that. And it's been a fantastic, one of the benefit of COVID is this type of virtual workshop is popping up. Yes, the impact investing is definitely something that I've studied and continue to be interested in. And it sounds like there are participants in this conference that are in this space and really have a lot of insights and perhaps great data at the granular level. The challenge that I faced in my previous research on impact investing is all we could get our hands on is the financial performance and also the identity of the investors. So we know the clientele, but we can't really have systematic data so far is on the portfolio companies and what really happened to those companies on the ground. And I would be very, very happy to be contacted by anybody who would be interested to share more insights or perhaps data on those portfolio companies. But it's been a pleasure. Thank you very much.
Thank you so much. And Don, I would love to hear your concluding remarks, please.
Well, as you know, I spent many years studying the real effects of private equity. And it was really exciting to hear, Joe, that your group is going out and collecting more disaggregated, comprehensive data on how these transactions are affecting workers, what the antecedents and the consequences of those transactions are. So to me, that's very exciting. And I think that investment professionals, I know that many people in your audience are investment professionals, they need to work with people like you. They need to work with researchers. Give us the data so that we can link the data sets together and explore these very important research questions that we've discussed today. And it brings back some memories. When I was writing my dissertation, Joe, I got data from the Securities Industry Association and Morgan Stanley on the deals, the very few leverage buyouts, management buyouts that occurred in the late 80s. And I was able to take that information and link it to the census data and really explore these issues that we've just talked about. I mean, is this good for the worker? Is it good for the economy? Is it good for innovation? Is it good for consumers? We can't answer those questions unless we have the data. So I'm excited that you guys are really pushing that and would love to help you with it.
Well, thank you very much, and I want to thank Ayako, Doug, and Don, and Oliver for joining us today. For those colleagues who have participated in listening to this symposium, it's sister sessions, our presentations by private equity partners and private equity firms in our symposium today that you can also watch, where these partners are actually presenting actual deals, actual case studies, and actual deal structures, which interact in a very concrete and particularistic way with the wonderful questions raised by these top scholars on private equity in the country. So thank you very much for joining us, and I invite you to come to the actual virtual conference on November 20th. Thank you, and good afternoon. Bye.
Thank you.